In the world of stock markets, dividends often serve as a beacon, attracting investors towards potentially lucrative opportunities. But sometimes a high yield could be a double-edged sword. Take, for instance, the case of Walgreens. Currently, it offers a tantalizing dividend yield of 9.4%, a figure that has raised more than a few eyebrows. Yet this high yield has not been without its share of concerns. Over the last 5 years, the stock price of Walgreens has seen a sharp decline, falling by a staggering 74%. This decline has been primarily triggered by fears of a potential dividend cut, reflecting the uncertain dynamics that often accompany high-yield opportunities. So, we're left with a dividend dilemma. Is Walgreens' high dividend yield too good to be true, or is it a golden opportunity in disguise? Stay tuned to find out. Diving deeper into Walgreens' financial performance, we find some intriguing insights. For starters, the company's profitability has been on a downhill slope. Over the last 5 years, Walgreens' stock price has dipped by a staggering 74%, largely due to concerns about a possible dividend cut. Speaking of dividends, Walgreens currently boasts a hefty 9.4% yield. However, the company's financial health is raising eyebrows. Walgreens is grappling with a highly leveraged balance sheet, which is inevitably putting the sustainability of its dividend growth under the microscope. Now let's turn our attention to some warning signs. Firstly, the company has a high leverage ratio, which essentially means that it has a significant amount of debt compared to its equity. On top of that, Walgreens is shouldering a considerable net debt. The company's recent quarterly earnings have also raised some concerns. While revenue growth was noticed, there was a decline in adjusted earnings per share, or EPS, which is a clear indicator of shrinking profitability. But it's not all doom and gloom for Walgreens. The company's new CEO is anticipated to reposition the business strategically, focusing on realigning with the evolving healthcare environment. This could potentially breathe new life into Walgreens, particularly in its U.S. healthcare segment. Despite these challenges, the new CEO's strategic business repositioning might just be the lifeline Walgreens needs. Looking ahead, Walgreens' future success hinges on its ability to adapt and innovate in an evolving healthcare environment. Under the helm of the new CEO, the company is expected to undergo a strategic realignment, focusing on the U.S. healthcare segment. This move could potentially boost the company's profitability and stock performance in the long run. The forthcoming earnings release is another critical milestone to watch. Although analysts project a decrease in adjusted EPS, they are optimistic about solid revenue growth. This mixed financial forecast, coupled with the overall market sentiment, could influence the stock price in the near term. Now let's talk numbers. Despite its underperformance in the past few years, Walgreens stock is attractively valued. The dividend discount model suggests a fair price of around $28, indicating a significant upside potential. This may seem like a bold claim, but remember, markets are not always efficient, and sometimes they leave room for savvy investors to seize opportunities. Of course, investing is not without risks. Concerns about Walgreens' profitability and the health of its balance sheet are valid. The company's high leverage ratio and significant net debt are undeniable red flags. However, the risk of a dividend cut, while present, is considered remote. Even if a cut were to occur, the savings would likely be used to deleverage the balance sheet, potentially boosting the stock price. So, where does all this leave us? Well, considering the high dividend yield, the potential for capital gains, and the strategic changes underway, it seems Walgreens presents a compelling investment case. Despite the challenges, the company's resilience and capacity to adapt could make it a worthwhile addition to your portfolio. While concerns about profitability and balance sheet health are valid, the potential for capital gains and a high dividend yield make Walgreens a buy. In the unpredictable world of stock markets, sometimes the biggest risks can lead to the greatest rewards. We've explored the performance and future prospects of Walgreens, a company that, despite its challenges, offers a high dividend yield that's hard to ignore. With a new CEO at the helm, the company is poised to realign its business to adapt to the evolving healthcare environment, offering potential for capital gains. While Walgreens is an exciting investment prospect, it's not the only high-yield opportunity out there. The dogs of the Dow strategy, for instance, suggests investing in underperforming but high-yielding Dow Jones stocks, a strategy that's historically outperformed after recessions, according to Bank of America. As we navigate the ever-changing landscape of the stock market, it's crucial to stay informed and keep an open mind. High-risk ventures like Walgreens, or the dogs of the Dow strategy, can offer significant returns if approached with diligence and a well-researched strategy. Whether you're a seasoned investor or just starting out, remember, knowledge is power. So don't forget to subscribe to our channel for more insightful stock market analyses. Until next time, keep your investments smart and your returns high.